Over the next 3 sections, we will be talking about how changes in a firm's inventory levels affect our understanding of firm profitability under absorption costing versus variable costing. In this section, we'll be looking at the scenario in which the number of units that the firm makes is equal to the number of units that it sells. In other words, the inventory level doesn't change. Throughout these 3 sections, we'll be taking a look at a company called LaserSave. This firm recycles toner cartridges for laser printers. We're given some information about the company for the month of October. We know that in October, the firm recycled 1,000 cartridges and sold them all. And we're given some information about the firm's variable manufacturing costs, fixed manufacturing overhead, variable selling and administrative costs, fixed selling and administrative costs, and the selling price for each cartridge. Let's look first at absorption costing. The manufacturing costs under absorption costing would include the $23 of variable costs per unit times the 1,000 units that the firm made and sold, plus the $20,000 of fixed manufacturing overhead, for a total of $43,000. That means that the manufacturing cost per unit in October would be the total manufacturing costs divided by the 1,000 units that the firm made. That is $43 per unit. On that basis, we can make an income statement for LaserSave in October under absorption costing. Sales revenue would be the $60 per unit selling price times the 1,000 units that the firm sold. Cost of goods sold would be the $43 per unit that we just figured out times the 1,000 units that they sold. Sales revenue minus cost of goods sold gives us the firm's gross profit for October. Under selling and administrative expenses, the firm had $1.25 of variable selling and administrative per unit times the 1,000 units that were sold. Fixed selling and administrative was $12,000, so we can figure out the total operating expenses for the firm in October. Gross profit minus all of the selling and administrative costs for the month gives us operating income. Now let's take a look at the same firm in October under variable costing. We were told that the variable manufacturing cost is $23 per unit. We were also told that the variable selling and administrative cost was $1.25 per unit. Now, let's make an income statement under variable costing. Sales revenue is still the $60 selling price times 1,000 units, but instead of subtracting out our manufacturing costs, we're going to subtract out all of our variable costs. $23 per unit of variable manufacturing costs times 1,000 units plus $1.25 of variable selling and administrative costs times 1,000 units. Add those together and subtract the total from the sales revenue to get the total contribution margin for October. But remember, the firm doesn't get to keep all of the contribution margin. You still have to cover the $20,000 of fixed manufacturing and the $12,000 of fixed selling and administrative. Add those together, subtract it from the total contribution margin, and we get operating income for October under variable costing. Let's compare the two methods. Operating income under absorption costing was $3,750. Operating income under variable costing was also $3,750. When we compare these amounts, it's very clear that when the number of units made equals the number of units sold, income is the same under both methods. In the next two sections, we'll take a look at situations in which the number of units made differs from the number of units sold.